Welcome back to Investing Talk Podcast. Today, we're tackling a question that seems to be on a lot of investors' minds right now. Is Applovin a good time to buy? This company's been making some serious waves, especially with, well, some pretty big news just recently.
That's right, Applovin. Yeah, it's generated a significant amount of interest, a lot of buzz. We're going to, look at what's really behind its recent movements and what the data is telling us.
So our mission today is to unpack all that recent information. We'll look at financial health, market sentiment, future outlook, really try to help you make sense of it all. And hey, before we dive in, if you find these discussions helpful, please take a second to subscribe, maybe like the show, and leave a comment below. We really appreciate it. Also, we'd love to hear from you. If there's a specific company you want us to look into, just let us know down in the comments. Okay, let's get into it. The big news, the thing sparking all this chatter, is Applovin getting added to the S&P 500 index. That announcement came just days ago, around September 5th, and boom, the shares jumped about 7%, hitting around $526.
Yeah, and what's fascinating there, it's not just the initial pop,
Yeah.
S&P 500 inclusion. Well, it often triggers forced buying from index funds. It's not just general confidence, it's actual institutional demand coming in. It signals renewed interest and, frankly, reflects broader market confidence. They're set to replace MarketAxess and Caesars Entertainment, with the changes kicking in before trading on September 22nd.
So for listeners who might just be tuning in because of that S&P news, what exactly is Applovin? Are they just, another ad tech player?
That's a good question. They are an ad tech, but their model is vertically integrated. That sets them apart somewhat. They basically operate as both a demand-side platform, a DSP for advertisers, and a supply-side platform, an SSP for publishers. They connect the two.
Okay, so they handle both sides of the ad transaction.
Exactly. And their main revenue driver, the big piece, is their DSP, which they call App Discovery. That's pulling in about 80% of their revenue. The other roughly 20% comes from their SSP, Max.
And I heard their growth strategy really hinges on something called Ericsson 2. What's that about?
Spot on. Axon 2 is their ad optimizer. Think of it as a really smart AI. It helps advertisers place ads, not just anywhere, but precisely where they'll hit specific return thresholds. It's kind of their efficiency engine. And it's clearly working, given their pretty substantial market cap of, $165.82 billion?
Okay, market cap is one thing, but let's talk numbers. This is where it gets really interesting, I think. The financial performance. Revenue growth looks really robust. We're talking a 50% increase over the past year alone.
Yeah, and even looking longer term, the compound annual growth rate is 18.4% over 3 years and an impressive 32.2% over 5 years.
Wow. And their 2024 revenue came in at $4.71 billion. That's up over 43% from the year before. Net income for 2024 was $1.58 billion, a massive 344% jump.
Huge jump. And even the trailing 12-month figures are strong, $5.74 billion in revenue and $2.43 billion in net income.
Those growth numbers are pretty staggering. What about profitability?
Just as strong, if not stronger. Their operating margin is 55.57%. Compare that to the industry median of about 12.5%. It's way above. Net margin, 45.72%, versus a median around 6%. Gross margin is nearly 81%, again, significantly higher than the median of 66%.
Those are just incredible margins. It really speaks to that software model you mentioned.
It really does. It's that efficiency kicking in.
Yeah.
Once the platform's built, scaling is incredibly efficient. Management's even guiding for adjusted EBITDA margins to approach 80% by Q2 2025. That's ambitious, but shows their confidence.
Okay, so top line and bottom line look great. What about the balance sheet? Any concerns there? Liquidity looks okay?
Liquidity seems fine, yeah. Current ratio is 2.74, so they can comfortably cover short-term debts.
I sense a but coming.
Well, yeah. Their debt-to-equity ratio is 3.01. That's definitely higher than the industry median, which sits around 1.74. So they are using quite a bit of leverage.
Okay. High leverage. Is that a major red flag?
It's something to watch, for sure. Leverage magnifies returns, but also risks. However, their interest coverage ratio is strong, 10.79. That means they can easily meet their interest payments right now. And other metrics are reassuring. The Altman Z-score is 23.73. That points to very low bankruptcy risk. And the Piotrowski F-score is a perfect 9, indicating really strong financial health overall.
So high leverage, but they seem to be managing it well, backed by strong operations. Got it.
Exactly.
Now, in this crowded ad tech space, what really gives Applovin its edge? You mentioned the integrated model.
Right. It's largely their tech stack, the real-time bidding, the Max platform for publishers, and critically, those data-driven targeting capabilities powered by Axon 2. Combine that with a growing base of publishers and clients, and they're in a pretty strong position.
But it is intensely competitive. You've got giants like Unity, IronSource, Google's AdMob.
Absolutely. And the whole industry faces risks, right? Technology changes incredibly fast. Think about privacy shifts, like Apple's ATT. Regulatory changes are always a possibility, and digital marketing demand can be cyclical. Ad budgets often get cut first in a downturn.
So constant innovation is basically table stakes just to survive.
Pretty much. You have to keep running fast just to stay in the race.
Okay, so taking all that in the strong growth, the high margins, the competitive risks, what does this mean for Applovin's valuation? You hinted it might be a bit rich.
Yeah, metrics definitely suggest the market has high expectations priced in. It trades at a premium. The price-to-earnings ratio, the PE, is around 69.64. That's high, even compared to its own historical median of about 67.
In price to sales?
PS is 31.86. The median is closer to 7.5, so way above median there. Price to book, PB, is kind of staggering at 142.1 compared to a median of just 12.38.
Wow, okay. Those are definitely premium multiples. What are the analysts saying? Are they still bullish despite these valuations?
It's interesting. The overall sentiment is still positive, a buy rating generally, with an average target price around $508.73. But, and this is a key but, the range of recent 12-month price targets from analysts, typically $459 to $483.3 or so, actually suggests very little upside, maybe even slight downside, from where the stock has been trading recently after that S&P bump.
So analysts like the company, but think the current price might already reflect all the good news and maybe then some.
That seems to be the implication, yes. Expectations might already be fully baked in.
And technically, how does the chart look?
Well, the Relative Strength Index, the RSI, is hovering around 71. That's generally considered near overbought territory, suggesting maybe the price ran up a bit too fast, too soon. On the plus side, though, the price is well above both its 50-day and 200-day moving averages, which supports the idea of an underlying upward trend.
In volatility, I imagine it's pretty high for a stock like this.
Oh, yeah. The beta is somewhere between 2.2 and 2.4. That means it's significantly more volatile than the overall market. Expect bigger swings. Recent data shows volatility around 9.87%, and it had, I think, 21 up days out of the last 30 sessions. So it's been on a strong but volatile run.
Now let's talk ownership. Institutional ownership is strong, you said, nearly 60%.
Right, 59.09%. That's solid institutional backing.
But insider ownership is quite low, under 5%.
Yeah, relatively low at 4.7%.
And this is the part that raises an eyebrow for me. You mentioned insider selling. What's the story there?
Right. This is definitely worth noting. In the last 3 months, there have been 23 insider sell transactions and 0 insider buys. That includes sales from the CEO, Arash Adamfuria.
Okay, 0 buys, multiple sales, including the CEO, during a period of really strong reported growth and right after getting into the S&P 500. How do you interpret that?
It's a signal you can't ignore. Now, sometimes executives sell for perfectly normal reasons, diversification, taxes, buying a house, whatever. But a consistent pattern of selling, especially from top leadership, with no offsetting buys, well, it can suggest that those who know the company best might feel the stock is fairly valued, or perhaps even overvalued at current levels. It doesn't automatically mean doom, but it adds a layer of caution to the bullish story, you know.
Yeah, it definitely makes you pause and think, doesn't it? So looking ahead, what are the key catalysts, positive or negative, that could move the stock? Q3 earnings on November 5th seems like the big one short term.
Absolutely. Earnings are always key. Expect volatility around that date, especially if guidance changes or they announce something new. Other things to watch near term, ETF rebalancing around September 30th due to the index change, maybe some big institutional buys in October as funds adjust. There's also an industry report on holiday ad spending expected around October 7th, which could affect sentiment. And maybe a product launch announcement they've hinted at around November 6th.
And longer term, you mentioned potential expansion.
Right. Management has talked about moving into an e-commerce segment. That could be a significant new growth avenue if they execute well. There's also always the background possibility of M&A, that they could be an acquisition target, given their tech assets. And maybe, just maybe, if the price pulls back significantly, you might see insiders start buying again, which would be a strong, positive signal. International partnerships are another potential long-term driver.
Okay, lots of potential positives. But let's revisit the risks. We talked competition and tech changes. Any other big ones?
A major one is their dependence on the mobile ecosystems iOS and Android. We saw Apple's privacy changes shake up the whole ad industry. If Google makes similar moves with Android privacy, that could significantly impact ad targeting and Applovin's effectiveness. That's a big overhang. There's also client concentration risk. Losing even a few large customers could disproportionately hit their revenue.
And you mentioned something about their tax rate earlier.
Yeah, that's another potential flag. Their current tax rate seems unsustainably low. While that's boosting net income now, it's unlikely to last forever. When that normalizes to a more typical rate, it'll create a headwind for year-over-year earnings growth comparisons. It's artificially inflating earnings a bit right now.
Okay, so putting it all together,
Hmm.
where do we land on Applovin? Clearly a company firing on many cylinders, great growth, fantastic margins, positive outlook from management.
Undeniably. Strong fundamentals in many ways. However, a lot of that good news really does seem to be reflected, maybe more than reflected, in the current valuation. The high valuation combined with the high volatility and the cyclical nature of the ad sector makes it look perhaps less attractive for a conservative long-term investor buying at this specific price point. It feels potentially more suited for shorter-term traders playing news events and earnings, especially given that current analyst targets suggest limited upside from here.
So it boils down to a classic growth versus value question, but amplified by the volatility and specific industry risks. And the question for you, our listener, is really about your own risk tolerance and time horizon. Does that potential for continued high growth, maybe boosted by e-commerce, justify paying a premium price today, despite the valuation concerns and that insider selling signal?
Exactly. Is the potential reward worth the elevated risk profile at this moment? That's the calculation investors need to make. Could that e-commerce pivot truly be a game changer, or will the high beta and sector headwinds dominate?
We've certainly covered a lot today, the S&P inclusion, the really impressive financials, the market view, the catalysts, and those key risks. Applovin is definitely a high-growth, highly profitable company.
But also one trading at a high valuation with some significant sector-specific challenges and question marks, like that insider selling and the reliance on mobile platforms.
As you think about Applovin's future, maybe consider how that potential e-commerce expansion, if it happens and if it's successful, could really change the whole narrative around the stock. That could be the next big chapter to watch. Okay, a final reminder, please do subscribe, like, and comment if you found this helpful, and definitely let us know which companies you'd like us to look at next time. Thank you so much for joining us for this exploration of Applovin. We hope this helps you feel better informed as you make your own investment decisions.